So after you factor in a higher minimum wage, higher insurance costs, higher utility costs, and now because once COVID started, we've had supply issues, supply chain. So I think the opportunity is going to be for someone like yourself, for someone like whoever else wants to get into the business. I think there's a lot of owners that have owned hotels for 20, 30 years that just don't want to operate them anymore because they can't make as much money as they used to because of the higher cost to operate.
All right, guys, welcome to another episode of The Report. Today, I got someone very, very special in town. I'm very, very excited for this episode because, as you guys know, I am really big into the boutique hotel investing game. And today, I got someone who's been in the hotel game for decades and decades and decades here in California as a broker, as an investor, as a lender. And he knows all the hotel owners here in California. So I'm very excited for this one. I got my man, Oliver Shah. Oliver, welcome to the show.
Hi, Rich. How are you?
Dude, doing very good, man. You are the vice president of Atlas Hospitality, man, and doing big things in the space. But first things first, why should someone listen to this right now be excited about the boutique hotel game as we move forward into 2026 and beyond?
Well, I mean, boutique hotels are sexy. They're fun. I like them because they're not so big. They're interesting. They're unique. Everyone is different. So I feel like, somebody like yourself who has a handful of boutique hotels, it's something, once you scale, they're easy to manage. And they're, like I said, they're sexy. They attract, a good amount of clientele in the right locations, which I know that you have been acquiring a lot of coastal properties in high barrier to entry markets. So, yeah, I'm excited to talk to you furthermore.
Yeah, absolutely. I think a couple things to unpack there that you mentioned. For one, yeah, we are targeting California coastal, well-located assets in high barrier to entry markets, supply constraint markets. And oh, by the way, beachfront California real estate, they're not building more of it, right? Um, some people are going out investing in the middle of the country. That's cool. But for me, like I want to be in sexy locations, and I believe the way to build true long-term wealth in real estate investing is to buy in great locations, let time do its thing, let inflation do its thing. And by the way, let's not forget the Federal Reserve has printed 80% of the money supply since 2020. Now, a couple of the things you said there, you mentioned management. As you get more scale, it becomes easier to manage. I do love that. I think in the beginning, it's like you get one and two, and it's like you're too small to really hire the people that you need to hire, and the staff and all that sort of thing. And you don't really have the reps and the at-bats. But as you start to really scale, and get more and more, and I'm actually very excited to see how this continues to unfold, but I'm starting to kind of see how that's playing out now as we start to scale. And, by no means been in the game nearly as long as you. I'm still relatively new, and so I have a lot to learn. But as I learn more and more about the game, and as we start to scale and buy more and more, I'm starting to see how the economies of scale does make things a little bit easier. It allows you to hire better personnel, allows you to lower your expense ratios, gives you more reps, more at-bats, and that sort of thing. Now, what are your thoughts big picture right now? Obviously, we have tightening Airbnb regs happening across the country right now. There's 8 million Airbnb listings in the world. And I always say, the way that people want to travel is shifting. The millennials, the Gen Zers, the modern travelers today, they don't want to go and stay at these same hotels that our parents or grandparents once loved. Even these, larger branded hotels, the Hyatts, the Marriotts that have, 500, 600 rooms. They have conference rooms and a lot of corporate stuff. These modern travelers don't like to stay at those hotels. They like these one-off branded boutiques that are Instagrammable, that are vibey, that they can go and experience and share with their friends on Instagram. And so as these 8 million Airbnb listings in the world slowly go away, and they are going away, you saw what New York City did. They banned short-term rentals. You saw what San Francisco did. You saw what LA did. Here in San Diego, for example, they slashed the Airbnb supply from 17,000 Airbnb listings to literally 5,500 listings. back in 2023. So as this happens, people are still going to travel. I think it bodes well for these smaller boutiques. And by the way, when you go to sell these boutiques, you mentioned this to me. You confirmed this to me when we were chatting the other night. You said some of the best investments to just park your money are these smaller boutiques in great locations along the California coast because they're very liquid. Sub $10 million because you can sell them at any time, because you can attract individual buyers, doctors, attorneys, those types of folks, but also more institutional as well, the folks that have a little bit more capital. Break that down for me.
So to give you an example, like if you have a small boutique hotel in a coastal town, and this is especially true if the value of the residential real estate in that town is quite high, quite often you'll have a boutique hotel and, it really fits in this size range. I'm going to say sort of in the, 20 to 35, 40 room range, where the price of that asset is not going to be astronomical. It may be just a little bit more, and in some cases, a little bit less than a purchase price of a nice house. Classic example, like we have, right now, a couple of properties in Laguna where if you take the lot size of the hotel and you take all the rooms combined, in some cases, they could be cheaper than buying a residential house. Now, it's zoned commercial, so it's not like you're going to be able to just build multi-residential on there, but just the value in itself, being able to sell it to somebody local, like you said, a wealthy doctor, a wealthy person that lives in town, it's quite easy to sell it to someone that's local if it's small.
Yeah, and especially, I mean, in that example, the Laguna Beach deal, how many rooms is that one?
So we have several for sale right now, but the one that we were talking about is actually 28 rooms. Yeah.
Mm-hmm.
Yeah.
So, in that example, 28 rooms, now that's in Laguna Beach. It's literally a half block off of the water. And that asset, I believe 1990s construction, so relatively new for that area. And so, that asset for Laguna location, well-located asset's going to trade at a lower cap rate than some of the stuff in the Midwest and some of the stuff up in the mountains. But to your point, you're buying good dirt. They're not building more of that dirt. You're in a supply constraint market. And oh, by the way, California coastal stuff is always going to trade at a relatively low cap rate. So your investment is going to be fairly safe long term and it's fairly liquid. Now, that same 28 room asset, to give you guys perspective, in some of the other parts of the country that are not in the water and maybe a little bit higher cap rate markets, you might be able to pick something up like that for $75K a door. Now you're looking at a deal that's maybe at, 2 million, 2.1 for a nice 28 room hotel with some upside, put 30 to 35% down on something like that. Now you can attract a lot of people. Now, curious for you, because you're a broker, you're an investor, you're also a limited partner, you invest with some of these other groups, and you're also an active owner as well. And so people tell me all the time, it's not just hotels, it's also other asset classes. They always say that deals go to die when they hit LoopNet. They've been picked through by a lot of investors. And, personally, I believe that is the case. But I also think that sometimes these deals, these listings go old, they go stale. And maybe these sellers had expectations day one that were not realistic expectations, and they have no activity for 6 months, 9 months time. And now their expectations change. And so maybe there's an opportunity for them to be willing to counter a decent buyer now. And so I guess my question to you is, do you feel like the only way to acquire a good deal is it needs to be off market? It needs to be something that hasn't hit LoopNet. It hasn't been picked through by hundreds and hundreds of investors yet.
No, not necessarily. So most buyers prefer it to be not on market, but really seasoned investors actually sometimes like if a property has been on the market for a long period of time, especially if there's a lot of price reductions. So something that we have a lot of experience in, me personally, is, sometimes, I'll take a listing and I'll be the third guy in, and I'll pass on it the first time because I just don't believe I can achieve the seller's price, and part of, being successful is knowing when to say no. So if a seller wants too much and I don't feel like I can get that price, I'll tell him, look, I can't get that price. I won't take the listing. He still wants to sell it at that price. he'll give it to somebody else, and they may fail, they may not
It
be
might fall
able.
out of contract.
Yeah, and then, sometimes I'll be the third guy in, but
Mhm.
by that time, the prices have already been reduced, 2 or 3 times, and it's become, right. So a lot of times when a property's been in the market for a long period of time, sometimes it just takes inexperienced brokers to, put it on the market and not succeed, and sometimes experienced brokers too. I mean, like, sometimes, I have failed, I've taken a property and, um, it's just difficult to sell, sometimes you're just, you're off. But, usually, when something's been in the market for a long period of time, uh, as long as the price has come down, or a second thing that happened is, the market's growing, um, it's been on the market a long period of time. Now the the price that a buyer will pay has caught up with the asking price because the property's continuing to grow. So timing, I don't think is an issue. I think it's more of an ego thing with buyers, making that statement that, "Hey, I want something that nobody knows about,"
Yeah.
just because,
It makes for a
um,
better story post-close. "Oh, we bought
they
an
don't
off-market
wanna they
opportunity."
don't wanna be the 2nd or the 3rd or the last guy to look at it. That's
Yeah.
just,
But you know what? Hey, sometimes if you're the 2nd or 3rd buyer, and it's fallen out of contract a couple times, maybe you're gonna get the best terms, you
it
know?
has happened, and I can give you many stories like that. Yeah,
Like the Catalina deal that Robert has.
correct.
I'm not gonna say the name of the hotel, but, they got a call for offer soon. I know that that deal has fallen out of contract at least 3 times, and now the seller's expectation has come down, and so I believe that deal is gonna trade at a smaller number than that thing was under contract for the first 3 times, and so whoever does pick this up, ultimately, hopefully, when it does get to the finish line, will ultimately get some better terms, hopefully.
I agree. I mean, that's, generally the principle is, again, you know, people always try to get a higher price, and, you know, it's all about pricing it right, is the key to, uh, getting a deal done.
Okay, so I got a really good question for you, and this is pertaining to inflation. I always say real estate is the best hedge against inflation, especially commercial real estate. But specifically with hotels, you've been in the game here in California for quite some time, so I'm sure you've seen a lot of inflation. Not just inflation of the US dollar, but you've seen inflation of the asset appreciation, right? The value at which these hotels are trading for. You've seen inflation with ADRs, you've seen inflation with RevPAR. Talk to me over the decades, kind of like big picture, what kind of inflation numbers you've seen with ADR, RevPAR, and also price per door in terms of comps here in coastal California.
So that's a very good question. I love answering this question, because, I only sell hotels in California, right? So, and, my biggest sales pitch is, so in theory, the best hedge against inflation is to buy gold.
Mm,
The worst hedge with inflation is cash, right? So with real estate, if you break that down, I believe the best hedge against inflation in real estate is trophy real estate. Okay. Real estate that's on the ocean, real estate that has extremely high barrier to entry markets. So we're talking, coastal California, wine countries, and high-end boutique towns, up and down the state. And there's a lot of towns like that. You have towns like Los Gatos, you have towns like Saratoga, you have towns like, even on the coast that I believe some of them are underrated, like I think you have a property up near Eureka, right? And which is a very underrated market. And then you have towns like Santa Cruz, and you have towns like Half Moon Bay and so forth. So generally, I've seen over the years, and classic example, in Laguna Beach, I can, without naming the specific property, but like I think one hotel I sold in Laguna 25 years ago, it was in the low, it was about 22 rooms. I think I sold it first time for 2.2, sold it again for 4.4. I think I sold it again at close to 8. And I think now, if we were to analyze it, I would say it's probably worth 15.
damn, it's a
Yeah,
22-room hotel in Laguna
yeah,
worth 15 million.
correct.
Wow. And
And that's
so the
happened over a
first
period of maybe 30 years, we're talking. Now, it
damn.
started 31 years ago, so
What are the main differences with it being valued at 15 today versus 2.2 back then? Was there a lot of different levers that the ownerships through the years have implemented, or are we just talking just straight driving higher ADRs?
A good question. So it's a combination of both. So at the beginning, the rates were much lower. Um, you're familiar with RevPAR.
Yep.
RevPAR is ADR times occupancy. But to give you an example, maybe 30 years ago, a good RevPAR for a property in Laguna would probably have been in the high 80s, 90s. Now a good RevPAR is approaching 300. I mean, that's a big difference.
Yeah.
We're talking
Yeah, it's 4x.
three, yeah,
3 to 4x.
3 to 400%. And so in theory, the real estate should also be 3 to 4x.
Yeah. But that 2.2 in that scenario would be worth 6.6, maybe 8.8. But you're saying 15. So where's the other injection come from? Is it food and bev? Is it getting creative with other levers? What is it?
So as you do, so again, the boutique hotel game, if you have a small number of rooms and you have a very high RevPAR, typically your NOI can be much higher. So as your NOI becomes higher, your value becomes higher. So if you're doing, let's say, $100 RevPAR on one property, your NOI may only be 30 or 5 or 40% of your gross room revenue. But if you're doing a $300 RevPAR, depending on what amenities you provide and what services you provide, your NOI could be 50% or higher of that room revenue. So now we're talking about a deviation that's much more than 3 to 4x.
Yeah, absolutely. Out of curiosity, is that deal that is potentially 15 million today? Is that right on the water or ocean views?
No, that's actually not on the water. It's on the other side, but it has good ocean views.
Got it.
Yeah.
Walkable too.
Sort of. Yeah.
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 So couple of the ways that we're differentiating ourselves with Summers Capital from the competition, as we get into 2026 and beyond, is a couple ways. So number one, we've put a AI concierge at every single one of the hotels. And each of these AI concierges has their own name and personality based on the market that they're in. So for our hotel here in Italy, for example, her name is Brooklyn. Brooklyn will text the guests in blue iMessage, use emojis, stagger response times, even intentional spelling errors, so it feels like a real human component. And Brooklyn will text the guests with early check-in instructions, helping them out before arrival, things to go do, restaurants to eat at, favorite things to eat at the restaurants, daytime activities like hiking trails, things to go do out on the water. If the guests need their rooms cleaned, or if the guests need extra towels, they just text the AI concierge. The AI concierge will ping the housekeeping. And then the AI concierge will also drive 5-star reviews with like room temperatures checks, like after the first night, hey, how's everything going on a scale of 1 to 10? If they say 4 to 5, she's like, great. Drops the 5-star, a Google link and says, hey, we're doing everything we can to turn around our reputation online. As we just did a nice renovation, it would mean the world to us if you could share your review and experience on Google. And then in addition to it, she's bringing in additional revenue in the form of like pet fees, early check-in fees, late checkout fees, etc., which is pretty cool. Now, the other way we're implementing and really separating ourselves from the competition is this. And a couple months ago, I went to the team. I said, I want an Instagram influencer at every single hotel indefinitely every single week. And so what that's doing is we have travel influencers with travel audiences going and staying at the hotels in exchange for a couple night stay. They're doing organic content for us, doing Instagram collabs. And so we're getting a lot more eyeballs, exposure, visibility, which over the long term is going to allow us to have higher direct bookings, drive higher RevPAR. But I think the big play for this is when we go to exit. When we go to exit these deals 10 years down the road, there's no doubt if we have Instagram accounts that we can sell with these hotels to the next buyer that have sizable audiences, 300,000, 400,000, 500,000 followers that are all people that have either stayed at the hotel or are interested in staying at the hotel. That's a massive lever that we can command a higher multiple and a lower cap rate at the exit. And so those are some of the levers that we're pulling. But I'm curious for you, what are some unique levers that you're seeing other owners pull in today's environment to separate themselves from the competition?
Okay, so on some of the independent properties, I'm seeing some guys drop a lot of the OTAs. They're doing their own marketing.
And they're just like OTA like literally independent. Like we're not going to do any OTAs. And by the way, if you're listening to this, you're like, what the hell is an OTA? OTA is going to be, anything like Expedia, Booking.com, Hotels.com, even Airbnb or Vrbo could be an OTA. They'll bring you visibility. People that book through the OTAs, they will charge you a commission, typically about 15%, give or take. Now, direct bookings are the best because one, you don't pay the commissions, but two, you now control that contact info. You get their email address, you get their phone number, you get to control everything from start to finish. And so it's always better to have direct bookings because, if you're dependent on OTAs, that means that you're not truly independently ran. And I actually know a couple, which I'll get into in a sec, where they just 100% direct bookings and that's it. But anyways, go ahead.
So a lot of the younger guys now are not branding as much now anymore. So you have a lot of big franchise companies that now have soft brands. So a lot of guys now are either deflagging their properties or they're going soft, especially on the smaller properties.
Why do you think that is?
Just based on the fact that a little bit what you said, a lot of the new younger people don't want to stay at a branded property. They want something different. And, people want a clean room. And I think originally the whole concept of the brand was to have consistency, to have a clean, consistent room. But now there's so many brands out there and people, they don't want that same room all the time. They want something different. And so if you soft brand a property or if you get rid of the brand altogether, you're not going to have that same consistent room. So you have you can still have the same price range. You can still have the same kind of property and the same kind of location and the same kind of construction, but you're going to have a variety of different room types. And not to mention the fees, right? When you have a brand, typically most of these brands will charge you anywhere from, depending on how you really calculate it.
The franchise fee ongoing.
Yeah.
And then they get the PIP, right?
Correct.
You got the property improvement plan.
Yeah.
And so you got to set aside money for that every 3 to 4 or 5 years. And that's mandatory improvements that you got to put into the property. Now, obviously, as a boutique independent, you still need to do those improvements, but this is stuff that conforms to the brand. Now, what are the most of these franchise fees if you want to work under a flag? Ballpark, what's the range? 6%? Give or take?
No, it's actually a little bit more than that. I mean, if
Really?
you take the true cost of it, because remember, a lot of the brands, some of the brands make you buy furniture from their approved vendors. So a lot of times that furniture is not exactly, maybe you only have 2 or 3 vendors that you can buy from. So the price may be fixed, but you're looking at anywhere from, I'm going to say on the low end, probably about 8%. That would be low, all the way up to 12, 13% if you count all the fees and the costs associated with owning a brand. Now, a lot of people will say some of the brands do perform. So I do believe that if you do exactly what the brand says, okay, the property will perform. But nobody does actually, I don't say nobody, but not everybody does exactly what the brand wants. Everybody wants to do what either they want to do, and a lot of times what they can afford to do.
Yeah. So like, if for example, correct me if I'm wrong, but just to summarize what you're saying, you could take 3 different owners in a similar market under the same brand, and owner number 1, owner number 2, owner number 3, even though they're under the same brand, are all going to operate slightly different. Some guys might favor driving higher occupancy. Other guys might favor driving higher ADR and a little bit less occupancy. And also payroll. Some guys might spend up a little bit more on payroll and say, hey, let's get the best personalities here that are going to have the best wherewithal and give us the best chance to really drive 5-star reviews. Other guys might say, hey, let's go a little bit more lean on payroll. Let's not bring in as high quality people, and we might run a little bit lower review average, but we're cool with that. Is that accurate?
That's correct. Yeah, absolutely.
Okay. So I look, I've never done the flag stuff, so I can't speak in regards to that. But one thing I will say, and I'm speculating, I'm always want to be wrong, but I strongly believe that the branded stuff was more valuable before we had social media and the internet, because they're going to bring you bookings and a lot of visibility. Think what was revenue management and operating hotels before the internet, before social media, before Google, Yelp, and all this. A lot of it's like, hey, we got the brands, they're going to bring us visibility. You got walk-in traffic. You got to be in a good location where you get a lot of cars driving by, a lot of visibility. But today, you can have a hotel that's tucked away. You're not on a busy road, not a lot of street traffic or visibility. Not use a brand, and literally just have a really, really good marketing, social media business plan, and leverage a lot of influencers that come in and out, driving a lot of 5-star reviews on Google, Yelp, etc. And you can create your own brand today and not have to pay the 8%, 12% franchise fee. What are your thoughts on that?
This is relatively new. I mean, that's kind of the reason why I'm here. I think I'm here because I'm learning from you, and obviously, hopefully we can learn from each other.
Yeah, you're the
But
hotel king, man.
well, I
I'm just
appreciate
getting
that.
started, bro.
But this is relatively new for me. I mean, I'm not on social media, so uh, this is something that I gotta really evaluate myself whether I really even want to be in all the platforms. But I am seeing
We gotta
that.
get you on TikTok.
Yeah, I am seeing the
So
younger
some
generation.
OnlyFans.
Yeah, they are staying at these small hip boutique hotels. And one thing I can tell you, again, going back to the location, right? And here's a classic example, right? I've traveled a lot all over the world, right? And just think about that hotel that is in a very touristy area, whether it's, um, in Venice, right on the Rialto Bridge, or wherever it is, in London, right on the river. You can have an independent hotel. The rooms could not maybe have been renovated in 10 or 15 years, but the place is full every single night, okay, no matter what. So you could have your own kind of room, however you want to run it, and you're going to be full no matter what because of the location. So I feel like if you have an excellent location and you have the right room count, meaning not too big, a lot of times you just don't need a brand, and that comes down to location. So,
Yeah, that's
um,
really good.
yeah,
So I think for us,
yeah.
when I look at our best performing hotels in our portfolio right now, the best performing hotels that we have are in these great locations along California coast, on the either on the water or just off the water with some sort of ocean view, but and good year-round tourism, but supply constraints. So meaning there's not a ton of hotels in the area. For example, we get a deal in Bodega Bay. We're one of 5 hotels in the entire market. They get 15,000 visitors every single weekend. It's only an hour north of San Francisco. Gorgeous, a lot of hiking trails right on the water. It's driving distance from a big metro area, and so it's a great weekend getaway. And so we go in there, we take over a property, buy it at a discount, and do a nice job with the renovation. We did $2.2 million reno, and a lot of the competition is very mom and pop. They're not doing all the Instagram marketing. They're not doing all the tech, the AI, and a lot of the rooms are kind of tired, right? And so we come in there, do a good job with that, and now we can command a very nice lift in the ADR. Okay, and so versus some of these areas, let's say that you're going to get into a market that has a lot of hotels, and there's just a lot of competition. And so in an area where there's maybe 1,000 hotels, you come in there, do a nice job with the renovation, you still have to compete over 1,000 other hotels. And so you're still a little bit handcuffed to the comps in terms of what you can charge on a nightly rate, and which is going to affect your RevPAR. And so when I see this data, and obviously, I'm always going to use the data to my advantage, right? I feel like those who pivot win the game. And so knowing that, moving forward with the last 4 hotels I'm going to put into this fund one, I really want to target core California coastal markets that are very supply constrained, that are in sexy locations, sexy assets, etc. My question for you is this: for someone listening to this right now, they want to get in the hotel game, they want to buy a hotel in California. What is your ideal search criteria right now that you're seeing in 2025, 2026 that is going to be the best performing, or maybe the best opportunity?
So I think what I'm seeing is a lot of owners, because, like you said, society is changing, um, demand is changing, desires are changing. So what I'm seeing is a lot of owners, and obviously operational costs, which is a big, huge thing. We've had insurance on hotels triple, if not quadruple.
They're starting to come back down though. I just had a good conversation with our insurance agent, this week, and these premiums we're seeing are starting to come down again, which
I
is good.
think it depends on the location. So I think what happened is, if you're in a fire area or close to a fire area, the premiums have definitely tripled or quadrupled.
Oh, especially with what
And then
happened
I
in
think,
Malibu.
yeah, and then I think a lot of the hotels, I think a lot of the insurance companies were like pricing it higher, even if you were like in an area like this where there's never going to be a great fire of like Chicago or London in an area like this. Well, knock on wood, but um, I think that's where it's changing. But other things have also gone up too, like operational costs, utilities have gone up a lot over the last 4 or 5 years. Labor rates have gone up everywhere. I mean, we're talking like some cities now have initiated a $20-$25 minimum wage. So we
Yeah,
have a lot of
which is crazy.
correct.
You know, I grew up in San Clemente. When my first job ever, I was 16 years old working in a movie theater in San Clemente, and I had minimum wage. It was 6.25, and this is not even that long ago. For perspective, guys, this is, I want to say, 2002. So 2002 minimum wage was 6.25. Fast forward about 20 plus years, it's now 25. So it's 4x.
So there you go.
That's crazy.
So I think a lot of owners just can't handle that. So after you factor in a higher minimum wage, higher insurance costs, higher utility costs, and now because once COVID started, we've had supply chain issues. So we've had issues with uh, construction costs, ordering new furniture for hotels. That cost has skyrocketed too. So I think the opportunity is going to be for someone like yourself, for someone like whoever else wants to get into the business. I think there's a lot of owners that have owned hotels for 20, 30 years that just don't want to operate them anymore because they can't make as much money as they used to because of the higher cost to operate.
Yeah, yeah. Interesting, interesting. Okay, question for you. So, we have, and we just pivoted this year. So we are fully integrated, right? And so the way my business is kind of ran is four arms. One is the media, the podcast, social media. It drives all the leads for our business, right? Number two is Summers Capital. We have investors. We give them passive income, tax benefits. We deploy that capital to acquire underperforming boutique hotels. And then number three is the hospitality brand. That's on-site staff, front desk, housekeeping, maintenance, driving five-star reviews, the revenue management, all the operations, the management that needs to happen, the guest communication, all that. And that arm of the business, we rebranded this year to Summers Collection because I thought, man, as we acquire more and more hotels, big picture, and eventually I want to have 30, 40, 50, 60, and eventually 100 hotels. And so it's like, what's the hospitality brand that's going to operate all these hotels? And so I want it to be Summers Collection. And so I guess my question to you is, big picture, when we go to exit down the road, is there an opportunity that you see to where I can even exit with the Summers Collection brand, this umbrella with all these hotels? And would that be something that could go and attract institutional capital?
I think as long as you have the product, which obviously is going to be boutique hotels in trophy areas, and you have the numbers, okay, as long as you have the and attract the institutional buyer, you have to have the NOI, okay? We're not talking about top line numbers. We're talking about NOI, net operating income. You should be able to package it, and you should be able to sell it to someone as long as you have several years worth of that. Yeah.
And they would want the whole hospitality arm with all
It
the
is
staff employees coming over.
it is possible to sell the whole collection. Yeah.
Very interesting. Very interesting to see how that plays out. Now, you mentioned to me the other week when we were chatting on the phone, and you said there was someone that does something similar to this. Remind me the name.
Um,
And he's got a
I
sexy
don't want to mention it on the
boutique.
phone. Yeah,
Okay.
I just it was just an example.
Pretty public guy though.
Yeah, I mean it's somebody that I think sort of he hasn't sold it, but there's other people that are doing what you're doing, which is that they're putting their own name on hotel brands, and I think there's an avenue for you to sell it to an institutional buyer as long as you have, like I said, the numbers, meaning your profit and loss statements and your tax returns, so forth. Any institutional buyer is going to want to see that, and obviously, the product itself, it's going to look good because I've seen your product and you do a great renovation. Yeah, it should be able to be sold.
Okay. Talk about what you're seeing with cap rates right now. Because obviously, what is a cap rate? A cap rate is a market's opinion of risk-adjusted return. And so, for example, a buyer in Oklahoma, Tulsa, Oklahoma, buying a hotel out there versus, let's just say, beachfront hotel in Santa Barbara. The buyer that's buying a Santa Barbara hotel is willing to accept a lower number of cash flow for the same purchase price as the deal in Oklahoma because that buyer in Santa Barbara knows that deal is more likely to appreciate a lot more in value over the long term than the deal in Oklahoma. And so it's important to remember cap rate is a market's opinion of risk adjusted return, but also on the flip side, we do know that these hotels and all commercial real estate for that matter, regardless of asset class, is valued based on NOI divided by cap rate. And so cap rate is a very, very important number. Now, cap rates will adjust based on market, based on economy, based on interest rate environment, a number of reasons. But what are you seeing California coastal hotels in terms of cap rates and the trends, especially in the high interest rate environment that we've seen the last 4 years?
So it's very interest rate driven, in my opinion, unless you have like a really, really trophy property, like, that's on the ocean in like Santa Barbara, then, somebody may buy it out of ego. You know, you have several billionaires that own very high end hotels that in some cases they weren't even cap rate deals. They were more of a trophy purchase. But generally, it's interest rate driven. So the general rule of thumb is that in the best markets, the cap rate is the lowest cap rate is generally going to be just a little bit higher than the lowest interest rate. So if you can borrow money at and we're talking long-term debt, right? So if you can borrow money at like 6%, 6.5% long-term, then the lowest cap rate is going to be probably somewhere north of 6.5%, 7%, best case scenario. So, and again, I'm not a big multifamily guy, but I have a lot of multifamily friends that it's sort of the same concept, right? I mean, if for the longest time you're able to borrow money on multifamily in the threes, right? So hence multifamily was selling in the high threes and low fours cap rates. So hotels never really went that low because you can never borrow money at that kind of rate on a hotel.
How low were the hotel rates like, when the rates were really cheap
The lowest I ever saw was,
for
I
perm
believe,
financing?
3.95.
Yeah.
Yeah.
That's pretty damn good
Yeah,
in
that's
today's
pretty good.
environment. Yeah,
Yeah.
I like that.
Yeah.
What is the biggest mistake that you see other hotel investors making?
That's a very good question. Well, hotels are a complicated asset, right? One thing, being a commercial real estate agent, even though I just sell hotels, you know, you have to know all the product types, right? And so the most stable product type, in my opinion, is multifamily. The most unstable product type is actually hospitality. And that's why typically hospitality cap rates are much higher than multifamily rates. So the biggest mistake I think people make is you get somebody from another industry, whether they come from the maybe they're an industrialist and they want to buy hotels because hotels are sexy. Out of all the product types, if you think about it, right? I mean, hotels, it's a sexy asset. I think even a restaurant in a certain context is sort of a sexy asset, right? But the biggest mistake people make is hotels are very hands-on, right? Even what you're doing, it's still more hands-on than buying a
Oh,
multifamily building
dude,
or an office,
it's not passive at all.
right? Exactly. So I think people think it's easy and they don't realize it's not easy. It's a lot of work. So if you're a passive person, I think the biggest mistake I see people make is people that are very wealthy, or very successful, they want to venture out and they think the other side of the river is greener and they want to get in the hospitality business. And then all of a sudden, they make a bunch of mistakes because they don't realize how much work is involved.
That's so good.
And
That's so good.
yeah,
And and to your point, it's not just people jumping over from other asset classes, but it's the doctor, attorney, or business owner that has his own practice, and he has a little extra money to go park, and he's like, "Oh, let me go buy a hotel because it's sexy. It'd be kind of a fun passion project," and he thinks it's going to be passive income because a lot of people just think real estate investing is passive income. I'm like, no, no, no. Buying a hotel is anything but passive. It's very, very hands on, and that's why we self operate. And where I'm like, I don't want to use third party because it's very hands on, and I'm kind of a control freak. But yeah, I agree. I could see that being like literally. A lot of people think it's passive. It's not passive at
And
all.
another thing is you got to do your due diligence.
Mm,
So everyone is always selling something for a reason. So my biggest piece of advice to everyone is nothing is handed to you on a silver platter. You have to do your diligence because if you don't, there's always a reason why somebody is selling something. And you have to find out what that reason is. And are you really getting a good deal?
yeah. What is their motive? Is it that they have a better opportunity they want to 1031 into because they're going to make a lot more money on that up leg? Or is it, hey, this is their problem deal and they just it's never performed in their portfolio and they're just finally ready to get rid of it? I mean, that could be something too, but I think
Or there's
finding the
something
motive, right?
happening in that market. Something else could be coming into that town, something else could be leaving. And so, a buyer has to do really good due diligence um, in order to make sure that, they discover uh, why a seller is selling.
Yeah. I had the national director of hospitality analytics for CoStar. His name is Jan Freitag on my hotel community call last week. And I was asking him all sorts of questions about the hotel economy, what he's seeing from a macro perspective. This is very national. And one thing he told me that really stood out is he said the assets right now that are performing the best and that are untouched by the economy are the unique assets, the luxury assets, the ones that have really good marketing and are more unique because there's not a lot of competition with those unique properties. And also the higher ADR properties, those guests are less affected by the economy. He said the ones that are not performing as great as they did back in 2021 right now are going to be the economy, the mid scale, the kind of lower and middle of the bell curve type of properties where there's a lot of competition and you're attracting guests that are a little bit more affected by the economy. And so I thought that was really interesting and kind of unique. And so, using that to my knowledge, I'm like, well, it kind of makes sense. And, it also really validates with like, as I look forward, I really wanna continue and do this even more so and really double down on this, but buying the sexy locations and do really, really dope, vibey, Instagrammable type of renovations and go into these areas that are supply constraint and just go heavy on the AI, the tech, the Instagram influencer stays, and really try to command really high ADRs. But anyways, I thought that was interesting. Any thoughts, on that?
You know, it it does make sense, because if you're a beginner in the hotel business, you know, I see a lot of guys start out in the business. They generally buy, I don't want to say an economy property, but an economy or a mid-scale property. Um, to buy a luxury property as a first-time buyer is, I built model rockets when I was a kid. That's like a four-stage rocket, so it does make sense. So when the economy's slowing down, the guys that are going to thrive are the guys that know how to operate hotels. Um, so, the guys that have a company that have their management intact are going to be the ones that are going to be able to weather the storm, and also guys that have less debt on their properties too.
I love it. Oliver Shah, this has been an amazing conversation. How can the folks get in touch with you if they want to learn more? And tell us a little bit about what you do with Atlas Hospitality.
Okay, so Atlas Hospitality Group is a hotel brokerage company. We've been in business for about 31 years. We're based in Orange County, Newport Beach. We just sell lodging properties in the state of California. So if you are interested in looking at any of our inventory, or you're a first-time buyer, or you want to sell your hotel, then you could reach me at Oliver at atlashospitality.com. That's my email address. Our website is www.atlashospitality.com, and you can reach me through either of those channels.
There it is. He is Oliver Shah, the Hotel King, always dressed to impress. Looking fly, my man. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you guys on the next one. Peace.